Interestingly, we established our real estate debt fund business over 15 years ago. So with our view of the market, I like to take a long-term view. And I'd say the opportunities, there are two main drivers, structural drivers and cyclical drivers in real estate debt. The structural drivers are regulatory change for the banking community, so traditional banks lending less. We have clearly, will probably remain on higher interest rates, which will then mean a different scope in terms of how people look at real estate and where the finance is coming from. And like in the corporate market, private debt is here to stay and will simply be increasing market share permanently for the long term. If we look at the cyclical opportunities and why this market is really interesting, there are again three factors. The first factor is simply deal flow, opportunities, much wider. And what we mean by that is not just the volume opportunity, but the quality of the sponsor, the quality of the real estate, and the sheer scale coming through. So that's the first. The second is definitely pricing and returns. People are prepared to pay outsize coupons and even participations in the deals to get the liquidity. And thirdly, the structuring's better. Whether it's depth in the capital stack, whether it's the covenants you can have, whether it's the controls and structures you can have, those are again cyclical factors that we're seeing in real estate debt. And my sort of final three things, the opportunities are different around the world. So opportunities in the US are people are prepared to pay quite high coupons to buy time, whether that's not to sell now, whether that's to buy time to lease and stabilize properties before refinancing. And in some cases, the last deal we did was a $200 million deal in New Jersey because the developer wanted to start now before everyone else and would borrow at mezzanine at higher levels to do so. In Europe, it is very much heavy sustainability driven, a lot of development finance and value add financing we see to fill that undersupply story. And so we do a lot of that there. But that works from a risk and reward perspective to the extent that you're ending up with properties that are best in the market. And in Australia, very much demand driven. Not a huge market, but what you're getting there is probably not hugely higher returns. But the returns are good, but the risk is really low. So across the world, we want to participate in all of those. And what we're seeing in the investor community is increasing amount of investors looking across the world. So from my own and my firm's perspective, the key is to offer investors the widest possible choice in terms of region, in terms of structure, so both they and we can take advantage of this point in the cycle.